everyone, a very warm welcome to everyone here. I hope that everything is okay from my side. I am audible, visible, and everything is fine. Just a minute. Okay. So let's start with the class. In today's class, we are going to cover this Basel-III framework on liquidity standards. And let me tell, everything is audible from my side. Let me check first. Yes, everything is audible. Basel-III framework on the liquidity standards. This chapter cover all the framework on the LCR, liquidity risk monitoring tools, LCR disclosure standards, and net stable funding ratio, basically LCR, and about the NSFR. These are the important things. These are the important concepts. Very important, we can say. Questions will be there from these two topics. Okay. Let's start. If I talk about the September 2008, the world here witnessed the collapse of Lehman Brothers, a major event that triggered the global financial crisis. And if I talked about 14 September 2008, here economist Paul Krugman asked, will the US financial system collapse today? Or maybe in the next few days? The very next day, Lehman Brothers filed for the bankruptcy, which marks the beginning of the crisis. Before this, the global banking system followed the Basel II, an international set of banking rules which is introduced in 2004. Now what happened when Basel II improved? Because Basel I, another we can say another thing is Basel II, which is improved, obviously improved version and better than Basel I, and it allows the banks too much freedom in deciding how to measure their risk. For example, some banks like Northern Rock in the UK were able to report much lower risk level than their actual exposures, which made them look more financially stable than they were. And due to this, they contributed to the financial crisis. Then, in this, basically they require higher capital adequacy requirement. There reduces the risk calculation variability. There are the leverage ratio, basically here, and RBI adopted these Basel III norms in 2015, which emphasize the financial crisis was partly caused by the banks which are taking too much leverage. And this leverage ratio is just to here preventing the banks from becoming too reliant on the debt. Okay, so in simple terms, this Basel III aims to make the bank more safer, to make the banks more safer by requiring more capital here, by requiring the more capital and limiting the risky behavior, and also prevents the excessive borrowing, which together help and reduces the chance of another financial crisis. Okay. Then Basel Committee, there are two important ratios, LCR and NSFR. These two ratios are very important, which helps the banks in managing the liquidity risk. And if I talk about the LCR, let's talk about the LCR here. LCR in very easy words. What is LCR? Liquidity coverage ratio, in which the bank's liquid assets to its net cash outflows, they are over for a 30-day period. The LCR is very standard, that basically banks meet to ensure that they have enough liquid assets so they can cover their cash needs during a financial crisis. Basically, it is a standard and it is designed to make sure that banks have enough high quality liquid assets that can quickly turn into cash. And this is the formula of the liquidity coverage ratio: stock of highly quality liquid assets divided by total net cash flows over the next 30 calendar days, which is here we can say greater than the 100% or equal to the 100. Then one more thing I am here telling you, that is about the HQLA's characteristic. HQLA, they have some type of certain qualities. They have low credit and market risk. They are very easy to value because their value can be easily determined. They are having a low relation with the risky assets. They are listed on the recognized exchange as well. And in level 1 assets, they are most liquid assets such as cash and cash equivalents. No haircut is required here. Level 2 assets, they are less liquid than level 1 assets, and they are divided into level 2 is divided into level 2A and level 2B. Level 2A, these are less liquid, and 15% of haircut is applied in the level 2A. But 2B, they are harder to convert into cash, and 50% haircut is applied when they calculate their value. Then one more important thing in this, NSFR. Basically, net stable funding ratio. This two things are important in this, LCR and NSFR. It is the ratio that measures the amount of stable funding. Basically, a bank has available, that is compared to the amount of it needs. So this NSFR, this is a key reform of the Basel Committee, which aims to make the banking sector more resilient. So in this chapter, only two things are important, LCR and NSFR. Okay, and both I already told you. If I give you the formula of the NSFR, so here NSFR is the ratio of the available stable funding to the required stable funding. Okay, so that is it in this chapter, which are important. I told you. Anything is there, you can ask me in the comment section. We will meet in our next class for the next chapter. Till